Welcome to another episode of Crypto Spendthrift Interview Sessions. I'm here today with Amy Wan. Go ahead and introduce yourself to the listeners.
Sure. So thanks so much for having me on the show. My name is Amy Wan. I'm founder and CEO of Bootstrap Legal. We have, a variety of legal technology solutions. One of them is basically we are building a dispute resolution infrastructure for smart contracts because they're actually quite vulnerable. I am a securities attorney based in the U.S. By training, and have worked in the startup scene and the legal scene for some time now.
All right. So, especially with all this SEC coming and clamping down, people definitely want to know about the entire kind of like what really is the risk of the SEC coming down on some of these companies. So we're going to start there by kind of defining the scope of the SEC. And it seems like that CFTC is the one who controls like the more trading. So is the SEC more along companies specifically, or like how they raise money?
Yeah, sure. So the SEC and CFTC are two different governmental regulators, at least in the United States, right? So the SEC, or the Securities and Exchange Commission, basically what they regulate is the securities industry. And what a securities is, I'm sure everyone by now has heard of the Howey test, right? But it's not quite as simple as the Howey test. The Howey test is, I would say, the fundamental framework of what is a security or investment contract. But there's also, decades of case law that defines and kind of flushes out how to actually interpret the Howey test. So I see a lot of conversation online about like, well, we, evaluate the Howey test ourselves, but that's not quite sufficient in most cases. Now, the SEC's mandate, right, their mission statement is they really look at two things. They care about capital formation, so they actually do want companies and people to be able to go raise capital, right? But the other mandate, I would say the competing mandate, is also investor protection. The SEC was basically formed after the Great Depression, when there was like crazy stuff happening on the stock market. It was completely unregulated. The stock market crashed in 1929, and a lot of people, were out of work, out of jobs, really poor. That's the whole Great Depression, right? And that's when the SEC came along, because they're like, hey, we do need to regulate the trading markets. Now, the CFTC doesn't necessarily care so much about investments. They care essentially kind of about everything else, right? They really care about commodities. Now, this does include derivatives. So it is possible for an ICO to be regulated by the SEC only, or the CFTC only, or both, to the extent it's considered a derivative. And so really, I see a lot of simplistic analysis these days online. People are like, taking that Coinbase questionnaire, filling it out themselves, posting it online, being like, oh, we're not a security. And that oftentimes really doesn't cut it. Now, SEC aside, though, I just want to also let folks know that it's not really just the federal regulators, the SEC or the CFTC, that people should be concerned about. There are actually securities regulators in each of the 50 states, right? So in many cases, depending on what someone's doing, if you are not considered a security under federal law, you might still be considered a security under certain state law, because they don't necessarily follow the Howey test. And then on top of that, all the regulatory stuff aside, there is what we call the plaintiff's bar. And that is, the network of very hungry attorneys that goes around trying to find work. And, basically right now they're basically suing all these ICOs.
There's a lot of those now.
Yes, I actually just got a private message yesterday from an ICO asking for securities class action defense counsel. So, this is the kind of stuff that, I think someone said yesterday on one of my LinkedIn threads, they said, an ounce of prevention is worth a pound of cure, right? It's going to be so much more expensive to fix this stuff afterwards than it is to, do it right in the beginning.
Especially if you have an unlucky fallout like that one Tezos ICO, like the whole argument there.
I mean, here's the thing, right? Plaintiff side attorneys, the ones who represent investors to go sue, they work on contingency. They're not going to sit there and settle for like a little bit. They are going to be super aggressive because, oftentimes they get 30% of whatever they earn for their client, right? They're not paid up front. And so, it is the type of person you want to avoid.
So speaking back about the securities, I see a lot of ICOs say they're not a security, but they're a utility token. So can you flesh that out, like what makes it fall under security?
Yeah, sure. So, a security token and utility token are not mutually exclusive. That's a fallacy. I don't know who's perpetuating it, but it just seems to be this common misunderstanding on the internet, right? So you can have a security that has some sort of utility function, and it would still be considered a security. Now, the SEC in various statements has basically come out and said, that they really haven't seen many ICO or token offerings that are not securities.
Yeah.
Now, they haven't ruled out the possibility that one can issue a utility token that is not a security. The problem is that the way people are structuring their tokens essentially doesn't really make it have a utility, right? So one thing I always point out is there's all these ICOs out there, and they're running around for their pre-sale selling to hedge funds and VCs and, these big funds. Funds don't sit there and buy, 10,000 widgets for resale. They don't buy 10,000 of whatever product, right?
Yeah.
Their mandate is they're making an investment. They have to make a return for their LPs or whoever their investors are. So, half of this is how you structure it. The other half is what you're doing, right? Are you going around and selling 10,000 at a time? Is someone going to need 10,000 of these to
use the platform,
utilize your network, right? Like, are they going to utilize your network 10,000 times? That's very unlikely, right? I always point to Kickstarter and Indiegogo, right? People there, they'll pre-sell a widget, but people aren't buying 10,000 of them at one time, right? They're buying one. Maybe they buy 2 or 3 as like gifts for family and friends, but that's about it. And it's not really being done speculatively for the purpose of like resale. That's really the crux of the situation here. I think, everyone has heard of that idiom, if it, walks like a duck and quacks like a duck, it's probably a duck. Here, if it looks like a security and you're selling it the same way you would sell a security and you're promising these, potential returns, oh, you might make money off of this, that's the duck here.
Yeah, basically almost every ICO has some kind of language like that, but then they try to kind of cover it up and say, oh, we're not a security, we're just raising money for our utility token. Or really crowdfunding. Yeah. I remember I saw an article recently how they're completely changing the language they're using in all of their marketing stuff.
Oh, it's so funny. I've seen people change the name from, oh, we're doing an ICO to we're doing a token sale to we're doing an initial token offering to, oh, we're doing a distributed token event. It doesn't matter what you call it. It only matters if it walks and quacks like the duck, right?
Yeah. So in recent weeks, the SEC has been really ramping up this kind of pursuing all these ICOs. Do you think there's going to be an increasing volume of these as we go along?
Absolutely. From what I hear in the back channel, the working group that is working on enforcing these is, very active, very substantial. They're making a lot of calls. And I think what you've seen here at the end of 2017 is kind of just the tip of the iceberg. I think they're going to come out with a lot more enforcement actions in the future, not only to penalize people, but also to kind of clarify through the industry what people can and cannot do with regard to being considered a security.
So how would this affect ICOs that raised money months ago?
So basically, the SEC said in their DAO press release that anything prior to that press release, so basically anything prior to July 27th, those folks kind of get a free pass, but it's also strange because they're kind of essentially stuck in legal limbo, right? To the extent that they ever did want to raise more money or go do a Reg A Plus offering or go list on an exchange, they are now in a very awkward position, and it's probably going to cost a lot of money to fix that. Now, anyone after July 27th, 2017 is pretty much, the DAO report was their warning signal, like, hey, we are watching you, right? Now you're on notice. It's basically now free for all. So anything after July 27th is fair game for the SEC. Now, just remember that's the SEC. That is not necessarily state regulators. State regulators can do whatever they want, and it's certainly not, it certainly doesn't apply to the plaintiff's bar, right? They will go and sue whoever they want.
Can you actually talk a bit more about state regulators? I actually didn't realize that there was like individual state regulators also.
Yeah, so, typically when a startup goes and raises money, right, they will usually use a federal exemption. And the federal exemption that most folks use and have used over the past couple of decades is Regulation D. And Regulation D basically says, okay, if someone uses Regulation D, then the SEC is in charge, and state regulators are basically, we call it preempted, right?
Yeah.
State regulators can't really do anything except that they can still require notice filings, which is pretty simple, and, it's still a way for them to make money. So they charge what we call blue sky compliance fees. Basically, every time you raise money from a state from which you've taken an investor, you have to pay them a small fee, right?
Yeah.
Now, if one does not follow federal securities laws, and there is no preemption, basically they are now also at the mercy of the states, right? So some states follow the Howey test, but not all states do. And what I usually tell people is, you have to think about this also from the perspective of, what's the most efficient way to do this? Do you want to deal with 50 state regulators, all of whom, have different varying levels of aggressiveness on how they want to come after you? Or, do you want to just deal with one entity, the SEC, right? It's one test versus, one regulator versus potentially up to 50 different tests with 50 different interpretations with 50 different regulators. And what I always say is I always prefer the SEC over state regulators because, you know, the different state regulators, you know, they may have different attitudes towards enforcement. So, for example, there's some states where their security regulators sits in their attorney general's office. And so, you know, a lot of those tend to be a lot more aggressive than the SEC might actually be.
Definitely sounds complex if you're trying to tackle all these states, and what might be okay in one state might be definitely a no-go in another one.
Yeah, and that's a lot more expensive to analyze.
So next up is something I'm actually kind of really interested in. Plexcoin is like, it was a Canadian-based company, yet it still kind of suffered the wrath of the SEC. Is there like certain laws with countries that allow this to happen, or were they operating in America which allowed them to be pursued by the SEC? Because I think
the latter.
Okay, because I think I heard
so here's the thing.
One thing about how if they operate in America or have like American employees, they can be pursued.
So it's not just operating in America. The security, at least the federal securities laws, right? They don't care so much about foreign investors. They care about American investors. So the moment you take money from an investor in the United States, U.S. securities laws applies. Doesn't matter if you're in Canada or on Mars. Like,
okay.
you know, U.S. securities laws applies. Now, I see a lot of misinformation like, oh, let's go incorporate in Gibraltar or Zug or Singapore, and then we don't have to follow U.S. laws. And that's not the case. It doesn't matter where you are. What matters is where you take money from. If there's so much as one U.S. investor, the SEC has jurisdiction.
So what about a case where the company like explicitly says Americans aren't allowed to invest, but American manages to slip in and invest somehow?
So that's where, So I've definitely seen offerings where, you know, there was one where in the 50 pages of legal paperwork, they said they didn't take money from U.S. investors, but there was actually nothing that prevented someone from investing, and they never said it on the website. I've seen other ones where they set up, you know, things that will detect your IP address, and, you know, they make you say that you're not from the U.S., but at the same time, like, that's actually still not compliant with U.S. laws because, well, one thing is a lot of these folks who invest in ICOs, they're quite technically adept, right?
Yeah,
so
they could get around it.
They just use a VPN, right? Really what ICOs need to use is AML KYC technology, which it'll take an investor's name. It will take, it'll run them against, a whole terrorist database, but also, you know, you will have to state where you come from, right? That's really what actually needs to happen here. And there are a lot of like AML, KYC, or ICO compliance platform solutions that are popping up. It's just, you know, there's a lot of people doing this the wrong way, and then there's actually an increasing number of people who are doing it the right way as well. It's just that, you know, for a lot of the people who are just scams, they don't care about doing it the right way. They just want to get their money.
Yeah, get the fast money they've been seeing from all these ICOs.
Yeah.
But actually, yesterday I covered one of the coins that are kind of evolving their ICO to be more compliant. Neo has this new template where before you even invest, you have to have like your address confirmed, like your whole identity confirmed by KYC.
Yeah, I mean that's definitely one of many solutions, right? At the end of the day, you know, identity verification is going to be a thing, right? There are certain people that we don't want investing in these things. And it's not just identity verification. Under the SEC laws, it's going to be the verification of, for example, their income or their accredited status, right? Because depending on what type of securities exemption you're using, you can only raise money from certain types of people.
Sounds like it's going to get increasingly complex as we go along.
Well, yes and no. I mean, these are the rules that have actually been around for decades. Startups have raised under these rules for decades. And actually, the rules today are a lot more lenient than, the rules in the past. Basically, under the Jobs Act, there are 3 crowdfunding regulations that came out, and they actually allow people to generally solicit or advertise and to raise money from the crowd, so not accredited investors. And so today it's actually a lot easier to raise capital than it's been for several decades.
Well, I guess just like the type of people in crypto probably aren't as enthusiastic about all this regulation, though, because I see it all the time with people complaining, even if for most of the time for the better. The regulations for the better.
Yeah. I mean, look, I will not sit here and say, like, I love the SEC rules, because there are certain things that I think about them, that might be, like, overly burdensome, right? But at the same time, there is logic and rhyme and reason about why these rules are in place. And I think if you actually look at the activity today that's happening in the ICO space, and you compare it to the activity that was happening in the 1920s, I mean, there are a lot of similarities. This is the reason why securities laws was put into place in the first place. And, I'll say this, everyone complains until they lose money, right? And if they lose significant chunk, then suddenly everyone is like, oh, why didn't the regulations protect us? Why isn't the SEC trying harder for enforcement? I've actually seen people comment that on LinkedIn now. And, oh, can I sue, right? So everything's good. Everything's immutable and self-executing and on the blockchain until people lose money.
Yeah, that's definitely true. And the opposite's true, too. People will keep their mouth shut when they're the one making tons of money from this.
Yeah, totally.
Interesting enough, I saw one Bloomberg article, too, that said some of the ICOs that had the best price afterwards, once they hit exchanges, were the ones that actually didn't deliver all that much. And the ones that actually delivered a product showed lower pricings.
Yeah, I mean, I'll say that right now, at least from what I'm hearing on the West Coast, like there's an increasing aversion to pre-product, pre-concept, pre-traction ICOs. And, basically, if you don't have, at least 12 to 18 months of runway, if you don't have at least a product out, if you don't have some sort of traction in your community, it's increasingly hard to get any advisors, any law firms, any service provider to help you.
Yeah. Well, now let's kind of finalize this. How would a company go? Like, just some general advice, how would a company would go without violating the SEC when raising funds during an ICO?
Yes, it's pretty easy. I mean, it's easy and it's not, right? Like, startups have been raising money for a long time, largely without violating SEC law. So, it's certainly not impossible. Now, I will say that if ICOs are going to, go pursue this route, they will have to expect to spend more money than they would with a traditional firm, because suddenly there's a lot more intricacy involved, right? They will have to sit down with their attorney, who's going to sit there and look at their token economics and question things. Whereas for a traditional startup, like it's just, oh, convertible note, safe, what's your cap, what's your discount, right? It's a lot easier of a conversation. But, for folks who want to be on the right side of the law and like avoid, all these class action lawsuits that are coming down the pipeline, they should go look for a securities attorney who has an understanding of the blockchain space. They will want to sit down and ask their securities attorney, okay, well, what's the best regulatory strategy for me, right? Because there's actually a number of different regulations you can use. Some of them are with accredited investors only. Some of them are, primarily with the crowd. Some of them are both. Some have, some are instant. Some take several months. Some have limitations on how much you can raise, right? So there's not like a one-size-fits-all strategy for everyone. And you can also mix and match these, or you can, initially start with one and then follow up with something else, right? So I would say go contact an attorney, sit down, have them help you figure out your regulatory strategy and your token economics to make sure that it's truly scalable. Do not make misrepresentations in your white paper. I've read white papers now that have claimed things that are completely technologically unfeasible, or they'll couch it in such vague terms that you're like, what are they actually building? Because it seems like they're trying to build the entire world, right?
Right.
So you don't want to make those sorts of misrepresentations. You certainly don't want to be doing, things that are red flags of scam artists, right? Like I've now heard of people pulling random people's photos off the internet and listing them as an advisor.
Oh yeah, that's been a big thing.
Yeah, like, don't do this the wrong way. All startup entrepreneurs exaggerate a little bit, but, there's not that fine line between exaggeration and fraud, right? And to the extent that it's fraudulent, it's a misrepresentation or an omission, your investors are actually entitled to rescission, which is, all of their money back. So if you're going to work so hard to raise that money, make sure you get to keep it, do it the right way.
All right. Anything you want to share? Like anything going on with your companies or anything like that? You can have the floor for the last little bit.
Yeah, sure. So my company, which is a legal technology startup, takes a slightly different approach to all of this. We had a lot of people contacting us this year asking us to see if we could legally represent them in their ICO. I'm a fan of, scaling and doing things in a very efficient way. And,
Definitely.
When we looked at the space, we didn't think that today was the day to automate ICO legal documents. But we stumbled across something I think much more interesting that I think anyone doing an ICO or working on a blockchain project should think about, right? And that is smart contracts. Smart contracts, in many ways, are not that smart. They are prone to coding errors, to security vulnerabilities. And the truth is, people will need to modify, amend, and terminate their smart contracts because situations change, right? And so we are building an SDK that folks can put into their smart contract. If anything is going wrong for any reason, the authorized parties can trigger the SDK. It'll freeze execution of the smart contract, give them an opportunity to either resolve their dispute themselves or gives them an opportunity to choose a dispute resolution vendor on our marketplace. And then for a lot of logistical and cultural reasons, the entire thing basically sits on a digital borderless jurisdiction because, there's so many issues with even bringing a traditional dispute into the traditional court system. A lot of these smart contracts are done pseudonymously.
Yeah.
You do not know the identity of the other party, so you can't actually name the other party in a complaint or serve them a complaint even. And even if you could, you basically will find yourself trying to explain to your counsel, judge, and jury your smart contract. They probably all sit there thinking, Bitcoin is fraudulent and illegal. So it's not a very friendly forum. And on top of that, they can't even read the smart contract. You'd have to, it's written in code. Less than 1% of the population can read code. So now you have to bring in an expert witness. The entire process of doing things the traditional way, it's not efficient. It's not effective. I do believe smart contracts are going to need some sort of safety net, and so that's what we're providing. So for anyone doing an ICO or anyone doing a blockchain project that involves a lot of smart contracts, we're basically trying to provide that safety net.
All right, that sounds pretty amazing, because I agree that there's going to be like a definite increase in use of smart contracts, and we've already seen at times where smart contracts go awry and people lose money. So definitely a good value.
That was the DAO, right? That was a violation against the intent of the smart contract, although not the terms. Parity wallet hack 1 and 2, that multi-sig wallet was done on smart contract. A lot of transactions in the space are done on smart contracts, but you can't sit there and expect the Ethereum network to hard fork every time something goes bad, right? So we're basically a solution to do this on a contract-by-contract basis.
And especially with the recent parity issue, they've been putting their foot down and saying, you guys will just have to basically wait until a solution is made by Ethereum.
Yeah. And that's the thing, right? Like, if they do ever decide to hard fork because of this, then Ethereum is basically choosing winners and losers, and that's not true decentralization, and that's not really fair to the rest of the community.
Yeah, it's a big controversial point still, even if like the DAO happened a while ago, but as more of these smart contracts mess up, the conversation just keeps getting sparked back up.
Yeah. Well, I can't sit here and say, oh, we're going to, be able to ever guarantee that a smart contract is coded correctly, and even if you have a security audit, that it will be free of security vulnerabilities. All I can do is sit here and provide a safety net for
minimize
the ones that fail
as much as possible.
Yeah.
All right, it was great having you, Amy. I learned a lot, and I'm sure once this episode aired, people will learn a ton because it's been amazing.
Well, thanks so much. I really enjoyed this as well.
All right. Thank you again. And this has been an episode of the Crypto Spendthrift interview sections. Expect this to be around January or something.